Hello, everyone. Bigbear.Ai is one of those AI stocks that looks exciting on the surface but tells a very different story once you slow down and really listen to the numbers. This company develops artificial intelligence software designed for edge networks, and about 4 years ago, it entered the public markets through a SPAC merger. On day one, shares opened close to $10, creating early optimism that this could be a major player in the fast-growing AI space. Fast forward to today, and that excitement has largely faded, with the stock now trading well below that initial level. Before going public, Bigbear.Ai painted a very ambitious picture of its future. Management projected explosive revenue growth, claiming sales would jump from just over $180 million in 2021 to more than $500 million by 2024. That kind of forecast naturally attracted investors looking for the next breakout AI name. But reality didn't follow the script. Instead of skyrocketing, revenue barely moved. Sales came in closer to the mid-$150 million range by 2024, falling far short of those early promises. Several issues contributed to this disappointing outcome. One of Bigbear.Ai's largest customers collapsed into bankruptcy, which immediately hit revenue. At the same time, competition intensified as more companies entered the AI module and analytics space. On top of that, broader economic pressures made it harder for customers, especially government agencies, to expand spending. All of this combined to stall the company's growth just when it needed momentum the most. In an effort to change direction, Bigbear.Ai made a major move in early 2024 by acquiring an AI vision company called Pangiam. Along with that deal came a leadership change. Kevin McAleenan, Pangiam's CEO and a former acting secretary of the Department of Homeland Security, stepped in as Bigbear.Ai's new chief executive. His background sparked optimism that stronger government ties would lead to fresh contracts and renewed growth. However, that hoped-for turnaround never fully materialized. While a few new contracts did come in, they weren't enough to restart meaningful revenue expansion. Looking ahead, management has actually warned that revenue could decline significantly in 2025. Part of the problem is disruption within existing U.S. Army contracts, caused by the federal government restructuring and consolidating its data systems rectums. At the same time, Bigbear.Ai's backlog is shrinking, margins are under pressure, and profitability remains out of reach. More recently, the company announced plans to acquire a generative AI firm called Ask Sage. On paper, this sounds promising, but it also feels like a last-minute attempt to plug revenue gaps rather than a clear long-term strategy. Analysts do expect a bounce in 2026 as Ask Sage is folded into the business, but that growth may be short-lived. Projections already show revenue flattening again the following year once the acquisition effect wears off. Despite all these challenges, Bigbear.Ai still commands a market valuation close to $3 billion. That places the stock at a very high multiple of expected sales, especially for a company with slowing growth and ongoing losses. In a broader market downturn, a valuation like this could come under serious pressure. Instead of asking whether Bigbear.Ai can finally break out of its slump, investors may want to look elsewhere for stronger, cleaner growth stories. One alternative that stands out is Innodata. While far less talked about, this company operates behind the scenes in one of the most critical areas of artificial intelligence data preparation. Innodata has been public since the early 1990s, but for decades it was a small, slow-moving business focused on digitization and data services for niche customers. Growth was modest, scaling was expensive, and the stock largely went unnoticed for years. Everything began to change around 2018 when Innodata made a strategic pivot. The company launched a new suite of specialized microservices designed specifically to prepare massive volumes of high-quality data for AI systems. This addressed a major bottleneck in AI development. Preparing clean, usable data often consumes the majority of time and resources in machine learning projects, leaving less room to actually build and refine models. That strategic shift turned out to be perfectly timed. As generative AI exploded into the mainstream, Some of the world's largest technology companies began relying on Innodata's services to handle their AI-focused data workloads. Over the past several years, revenue growth accelerated dramatically, and profitability improved just as quickly. Earnings before key expenses multiplied many times over, reflecting the scalability of the new business model. Looking ahead, Innodata's outlook remains compelling. Management expects extremely strong revenue growth in 2025, followed by even more significant expansion as AI adoption continues to spread. Analysts largely agree, forecasting rapid sales growth and rising profitability over the next couple of years. Unlike Bigbear.Ai, Innodata doesn't depend heavily on rigid government contracts, nor does it need constant acquisitions to fuel growth. What makes this comparison even more striking is valuation. Innodata's market cap sits well below Bigbear.AI's, yet it trades at a much lower multiple of future sales. If Innodata simply meets current growth expectations and earns a slightly higher valuation multiple, its market value could easily surpass Bigbear.AI's within a relatively short period of time. The takeaway here is simple but important. Not all AI stocks are created equal. Some are weighed down by missed forecasts, contracting margins, and uncertain strategies. Others quietly build scalable businesses that align perfectly with where the AI industry is actually headed. For investors looking beyond the hype, focusing on companies with strong fundamentals and clear growth drivers may offer far better long-term results. This is not financial advice.